Call the hearing to order. I first want to thank Senator Crapo for joining us today and also for his collaboration over the many months as the ranking member of this subcommittee. And thank you very much, Senator, for your excellent work. And let me also welcome our witnesses. This morning we are examining the housing finance system, specifically the to-be-announced market. In May, the subcommittee conducted a hearing on the state of the securitization market. This morning's hearing continues the subcommittee's examination of the securitization markets with particular focus on a part of the securitization system important to housing finance, and this is the to-be-announced or TBA market. In the early 1970s, the TBA market began as a trading venue for securities that were issued by Ginnie Mae, and its role expanded as Fannie Mae and Freddie Mac began issuing mortgage-backed securities. This market has evolved, and today it is one of the deepest and most liquid markets in the United States, with average daily trading volume in excess of $320 billion, a market second only to the market for the United States Treasury securities. The name of the market, to be announced, comes from the way the market functions. Unlike a traditional marketplace, investors do not know the specific collateral or pools of loans they are agreeing to purchase until months later. Accordingly, the collateral is designated to be announced at a date in the future. Many argue that the TBA market is vital for preserving key products that consumers have come to rely upon in buying a home, such as a 30-year fixed-rate loan, freely prepayable mortgages, and the ability to lock in an interest rate prior to closing a mortgage. Although the only securities traded in the TBA market are agency securities, defined as those securities issued or guaranteed by Fannie Mae, Freddie Mac, and Ginnie Mae, the TBA also serves as a benchmark for privately issued securities. Privately issued securities are priced relative to the TBA price. In addition, originators use the TBA market to purchase and sell positions to hedge the origination of loans that are not eligible for trading in TBA. For example, adjustable rate loans and jumbo loans. As we continue to explore different approaches to reforming our housing finance system, it is critically important that we understand how the TBA market works and what impact any reforms will have on this market. How will any changes affect the availability of the standard mortgage products sought by consumers? What characteristics of this market, if any, should be preserved? I look forward to hearing from all of our witnesses this morning on these issues. In fact, this is a very technical but vitally important part of our securitization and our mortgage industry. We have to understand the basics before we move forward. But as all of our hearings, the point is to accumulate the information and the insight so that we can start dealing with some major issues with respect to housing, with respect to the GSEs. And with that, I'd like to introduce the ranking member. Senator, let me begin with a question to all the panelists. You've all highlighted the fact that the TBA market does affect the availability of certain mortgage products, 30-year fixed mortgage loans, the ability to lock in interest rates, et cetera. Changes to this that we're talking about, how would they affect these characteristics? I guess the other way to ask it, too, is this ultimately going to be a trade-off in terms of what we expect of a mortgage today, fixed rates, locked in, 30 years? How is this all going to interact? And I'd just like your general comments, starting with Mr. Hamilton and down the road.
I think there's definitely a trade-off. I think one of the large benefits of the TBA sector and of the agency guarantee is that we were able to get 30-year fixed mortgages and keep monthly payments low. I think the elimination of that would absolutely force us into either a floating rate market or something that certainly has shorter duration and more volatility for the homeowner in their monthly payments.
Mr. Van Valkenburg?
Yeah, I think as it stands now, the government guarantee is necessary to enable the risk to be absorbed by the investor and transferred from the homeowner. So I think it is the guarantee is functioning that today. The mechanism that the borrowers and the market, the TBA serving to the mortgage companies, they're basically price takers. They take the information, and if they have an outlet to sell the the loans, they'll use the mechanics in place. So having a liquid market will, and having a liquid outlet for 30-year mortgages is the means by which they can execute that transaction.
Thank you. And Mr. Davidson, your comments just in general.
So certainly without some guarantee, we're likely to have far fewer fixed-rate mortgages. Those rates would be higher. But I think probably more importantly than any of those is that the stability of the availability of mortgage credit would be much lower. We've seen that, the private markets, when you go through a shock to the financial system, just step back for a while, and then it takes a while for them to recover. So during that time period, mortgages would just be much less available.
Let me sort of ask the question again, starting with you, Mr. Davidson, saying that a lot depends in terms of where we come out is what goals we have when we go into it. And if the goal is to maintain, which people assume is the American mortgage, long-term, maybe not 30 years, but 20, et cetera, fixed rates and relatively low monthly payments, can we do that without a guarantee by the federal government in some way, shape, or form?
So it's hard to say it wouldn't happen. So it's certainly much less likely that we would have the number of, the percentage in 30-year fixed-rate mortgages without the government guarantee. It turns out there are some investors who want to buy interest rate risk and can take prepayment risk, but don't want to deal in credit risk. They want to be able to engage in transactions where they can buy hundreds of millions or multiple hundreds of millions of dollars worth of securities at one point in time. And without removing the credit risk, it's difficult to see how you could create that kind of market.
Mr. Van Volkman, yeah.
I think if we said tomorrow, hey, let's start a market for, it would obviously fail to transfer the risk involved in a 30-year mortgage. But if we could develop a process where this credit piece could be transferred into private holders of the risk, everything comes down to a price, at what it's worth. And we don't know what the price would be at this point because the government's basically assuming that risk and subsidizing that risk. So a market would have to take years to develop in order for that risk to be priced and risk takers and markets to develop before we could understand really what the potential investors would require on a fee in order to absorb that risk.
Right. Now, and Mr. Hamlin, your comments.
I would just say the market will develop for whatever the rules are brought to them. But what I'd say is certainly the 30-year mortgage would be less available. Mortgage credit would be less available, and the credit availability that you'd be able to access would be at a significantly higher price and would have a significant impact on the housing market.
Okay. Let me ask another question, which has been alluded to by all your testimony, and that is, right now there's a lot of capital going into this market because of the way it's structured, the guarantee, the credit risk aspects. And the presumption, I think the conclusion from all your comments is that in some respects that capital won't go there any longer if the guarantee is changed significantly or it's a private system. And it raises the question is, where does the capital go? We might not know, but is that a bad thing or a good thing? And in terms of the overall economic performance of the country. So this is very speculative, but
Sure.
Feel free.
Listen, there's a lot of foreign investment, foreign capital, insurance company, money management, retirement funds that are putting large amounts of dollars into the U.S. mortgage market, and that's due to the fact that they don't want to take credit risk. Is there a market for that credit risk? I believe there is, but I think we're talking about a very large transition from a mortgage market that's determined by rates and investors who care about rates to an investor who cares about credit. And that transition can take, to do it in an orderly fashion, we're talking about 10 or 15 years. This is not an easy scenario.
Mr. Van Valkenburg and then Mr. Davidson, and then my time is done.
Yeah. And anytime you subsidize anything, you get more of it. So I think the government is subsidizing the housing sector in many ways, with the many along the food chain. In particular, the guarantee is just one area, but so we probably get a little more access to consumer credit than we would otherwise. But it's hard to quantify these things without any kind of real price discovery about what things are traded at or what private institutions would pay for that risk.
And part of this transition phase would, in a sense, be that price discovery process of seeing.
Yeah, I mean, if we could develop
Right.
credit markets that, where we could transfer that to the private financial institutions, we could begin to understand what those costs are, what willing private parties are willing to pay for that risk, and move the credit risk into across the world instead of just localizing it, concentrated on the government's balance sheet.
Ms. Davidson, your comments, please.
I think it's important to separate the liquidity function of the guarantee from the credit function of the guarantee. So on the credit function, I think the credit risk should be moved into the private market. It was supposed to be there before, just that Fannie and Freddie didn't really have enough capital. The liquidity function is a lot like deposit insurance. And deposit insurance keeps confidence in the banks even when there's uncertainty in the financial system. And so that function, I think, does serve a valuable purpose. The mortgage market is gigantic, and rather than moving more of the financial system into the banks where we have more deposit insurance, this is really another method of providing a liquidity guarantee to important financial sector. So I think you can have an economic benefit without having significant costs to the government.
Thank you very much, gentlemen. Mr. Senator Crapo. Thank you very much, Senator Corker. I've got a few additional questions, but I think in the line of questioning both Senator Crapo and Senator Corker have developed has been excellent. It exposes kind of sort of the real policy choices we have. I mean, we have collectively for generations, both Republicans and Democrats and everybody else has said, you know, putting people in homes is key to America, and it's resonated. And as a result, a lot of these programs were begun to do that. And now we're at the point where we're looking at, you know, how do we make a transition? How do we do it in an effective way? How do we price it correctly? How do we maintain a market? And this hearing, despite the esoteric title, is absolutely central to what we're going to do going forward for all the reasons that Senator Corker and Senator Crapo have indicated. Can the private market step in? Will they step in? So let me just ask a few other questions, but I will also join Senator Corker in inviting you to come by the office because we're not going to settle this morning. It's going to be a dialogue going forward. But I'll begin with Ms. Davidson, and a question is that, again, if my understanding is incorrect, please correct it, but the TBA market is not subject to the securities laws, that it is exempt because of the participation of the GSEs, the agencies. If we move to a private market where these activities have to be performed by exclusively private firms, would that induce SEC registration requirements and other forms? And if that's so, would that complicate things further, or how should we think about that? Maybe that's a more general question.
So currently, loans that are delivered into the TBA market are exempt from SEC registration. So that allows you to essentially sell them before the securities are created. So in the private market, an issuer can't do that. They can't say, I'm planning on securitizing next year, please buy this, or next month, please buy the security in advance. And so that just eliminates the possibility for physical delivery into a forward sale. So other mechanisms could be developed, but they're just not going to be as efficient, or maybe there could be, some exception created for some type of mortgage issues. But the SEC is going in the other direction right now and sort of requiring more disclosure, more detailed disclosure about loans and longer time periods between when you announce a deal and when you sell it. So the SEC's direction is sort of contrary to what you need to create a TBA-type market for non-agency.
So one of the aspects of creating this new, and we all understand this is not going to happen next year, this is a phased adaptation going forward, would be to provide investor protections, but perhaps not in the same way that is done presently by the SEC and private labels, but that to work both of those features in, the rapidity, the liquidity, the ease, the uniformity with the investor protection. So we'd have to deal with that, I guess.
That's correct.
There's a one of the proposals, and this was again Mr. Valcro opposed, that we ensure liquidity in market. A single issue with uniform capital markets accepted practices is necessary. Essentially separating the guarantee function from the insurance function, and the issuance function, rather. And Ms. Hamlin, can you comment on that approach of separating the guarantee function from the issuance function?
Are you saying separate the government guaranteeing it or someone private guaranteeing it?
I was,
Function itself. Do we need to have multiple issuers? I guess you're reading
yeah.
from my testimony.
Yeah, go
I
ahead.
was just suggesting the issuance to be a single issuer so that as investors aren't confused if it's ABC issuer, XYZ issuer, it's always done by the same issuance, and then the guarantee function could be priced independently, or the role can be determined independently.
And I won't put words in your mouth, but if it's a single issuer, that likely could be a government entity.
Yes, it could be.
I think they're all saying the same thing. I think that separating out the guarantee function is what we're talking about. Like when we discuss selling, when Mr. Davidson says selling subordinate tranches off of agencies, or selling, credit risk in a CDS or credit default swap off of a certain pool of residential mortgages, it's all accomplishing the same thing. We're trying to separate the guarantee function and mitigate and sell that credit risk so the taxpayer's not on the hook, yet at the same time maintaining one issuer or a couple of issuers and maintaining that liquidity. So I think it's all saying the same thing in a different way.
Ms. Davidson, it's your thought, so do you want to elaborate?
Yeah, he's Mr. Davidson.
Oh, excuse
Yeah.
me,
I'm not as good looking as he is. No, but,
Mr. Van Valkenburg.
yeah, thank you,
Excuse me,
Senator.
sir.
I was basically, in the current TBA market, there is a perception of, Fannie Mae has a better liquidity than Freddie Mac. It's minor, 2 or 3 ticks. I don't know. Tom knows better than I. But so name and issuer name is significant as far as liquidity, so that was basically it. I think if we get into too many issuers, it's going to confuse the investors, which is going to affect the level of liquidity. So a single name issuer was what I was advocating, and the guarantee function separated. So I think it costs us in liquidity if we have multiple issuers.
Right, but I mean, in just thinking back, I think that's a way we sort of walked ourselves into the GSEs, which is basically, if you're going to give a monopoly, then it's got to be quasi-governmental at least. Otherwise, the monopoly profits go to someone. That's not our tradition. So this approach, I think, would imply the issuer would be some type of entity, either very closely regulated by the government or some quasi-governmental entity, and then the guarantees would be subject to market pricing and market activity.
Exactly, and we're not going to get a credit market established quickly, but we could develop that over time. It's the current infrastructure with a 30-year guarantee is not going to go away tomorrow, and it's going to take time for that to develop. But
Right. Mr. Davidson, your comments, and you are Mr. Davidson.
Yes, I am Mr. Davidson.
Forgive me, it's vision as well as.
One idea is that if you're going to have this single issuer or a few issuers, to avoid this monopoly situation, is that you can allow that to exist only as a cooperative. So some sort of industry cooperative like the DTCC. And so that if there is monopoly profits, they have to go back into the chain where it's competitive, either above or below that cooperative. But I do think that having 1 or 2 issuers is good. Trying to get as many participants to take the credit risk is good, but you do have to find a way of standardizing the mortgage products. So let's say we had 20 different mortgage originators, all who would go through this one guarantor, but they all had 20 different loan documents, 20 different types of disclosure. Then we'd have 20 different markets, and that isn't going to promote the liquidity we need. So it's just a careful balancing act between spreading the risks and standardizing.
Let me ask as a final question and to all of the panelists, but I'll begin with you, Mr. Davidson, which is you have proposed this subordinated debt approach, but I think it implicates a bigger issue, which is recognizing that we should probably begin to take steps now to begin a transition, that legislative steps, because it takes a long time to get legislation through and because of the potential is not likely going to happen today or even next year, et cetera. But as you suggest, and I think everyone on the panel has suggested, there are things today that should be considered to begin this process, maybe even experiments which don't work out and save us the trouble of trying them in the future on a larger scale or adopting them as an exclusive remedy. So if you can comment on your subordinate approach, how it might work, and is it feasible to begin to adopt it today? And then I'd like to ask the other panelists to think of either what other steps that you would suggest, again, outside of legislative, but within the purview of the agencies today and as you understand, as the legal framework. So let's begin with Ms. Davidson.
Yeah, so the subordinate approach is something that the GSEs have done in the past, and
Mr. Hamilton pointed that out. Yeah.
right, sort of in the multifamily area.
Yeah.
And I believe it is something that the GSEs are exploring currently, different ways of adding private capital. And so it's certainly doable within the with the existing structure, that they probably do need the approval of FHFA. I don't know if they need the approval of Treasury. And I think they can move in that direction. I think they should try several things. So I like subordinated bond approach. Other people might think they should use more private mortgage insurance. And I think the key factor there is sending the message to FHFA that experimentation is good. That's what you want to see. And you don't need to have sort of a sole focus on conservatorship of every dollar today, and that finding the right solution actually adds value to the GSEs over time. And the other important component is to try and move the dialogue away from, well, let's destroy eliminate the GSEs tomorrow because they were bad before. The managements who did that are all gone, and say, are there pieces of the GSEs that we'd like to preserve over time? So anyway, I think it's doable.
Thank you. Mr. Van Valkenburg, please.
Yeah, I proposed one. The wrong button. Yeah, I proposed one idea, but there's no single monolithic solution. All these markets are complex, and they price risk differently, and there's different audience of investors. So the subordinated bond solution may be the best solution. We don't know until we actually go out and try to execute and see what the price and the cost of that credit is. So I propose the CDS market just as a one avenue of exploratory thought. So I don't have a particular single solution, but I think you have to price it, find out what the costs are, and find out what's the best execution for the government's balance sheet.
Okay. And Mr. Hamilton.
I think we end up with a portfolio of things we need to work on in the interim, given the likelihood of legislation in the near term is low. The FHFA can obviously play a large part in this. Lowering of the loan limits is one step. We could lower them further on a gradual basis over the next 18 months would be the next step. It would enable the private market to open up. I think the FHFA you could limit the amount of borrowings that banks can do from the home loan bank system. You could encourage the covered bond legislation and market to open up to be another funding vehicle. I think there's a portfolio of approaches that are going to attack the U.S. housing system and be the solution for mortgage finance. And I think there's quite a few of these we can do in the next 18 months without legislation. And I think those are just a few of the things we should work towards and then I think we'll find the answer. We'll rise to the top quickly.
Well, thank you very much. Gentlemen, this has been very, very helpful to the subcommittee. And as Senator Corker suggested, please don't be surprised if you're called again to forget your views and your advice, because it's been extraordinarily helpful. And thank you very much for your testimony and your appearance today. Some of my colleagues might have additional questions. We'll ask that these questions be submitted before the end of the week. It's Wednesday, and so by Friday, I think that's fair. And then we'll get them to you and ask you to return them as promptly as possible if there are any written questions. Again, thank you very much. The hearing's adjourned.
Thank you.